What a wild ride it's been this week, guys. Jobs came out this week and it was almost double what they were expecting. 383,000 new jobs were added. And then they dropped a bomb. And I say they, the Bureau of Labor Statistics, which does all this for us, said, oh, by the way, we changed how we count jobs. So the street was expecting 185,000 jobs, 383,000 came in. So what did that do to the interest rate market for mortgages, for houses? So guys, this week on True Talk, I want to talk about dissecting numbers and understanding what you're getting, because ultimately we do not control how the numbers come out. We have to interpret them and be able to work within the numbers that we're given. And I'll tell you this, there's going to be some type of revisions going forward for these numbers, because there's no way that we doubled the amount of jobs that they were expecting and there not be duplicates or something going on. The market went crazy and reacted to it. And then all of a sudden it's the 10-year treasury started coming back down. And I think this is really like life. We react to something so quickly and we just take right off instead of waiting, digesting it, and then trying to figure it out. And within this space, since I'm relatively new to the lending space as a loan officer, but not as working with loans, because done all my life, originating, I should say, there seems to be a lot of noise when it comes to where the market's going to go. And to be honest, I don't know where the market's going to go. I sell today's rate. So if the rate is 6.5, that's what the rate is today. I can't worry about the future or the past. And there's just a lot of people talking about what the future is going to be. And it's not a single person on this face of this earth can actually time the market. So if we can't time the market, why do we try to time our lives? And I know I'm digressing, but that's really where I want to go is we have to be better at working on our lives, being consistent, being persistent, being present when we're working on something, whether it be work or personal lives. And we struggle with that. And that is a huge struggle that we all have. I have it too every single day, trying to be present. A good example of this is when I'm sitting here working and I'm worried about emails coming in and text messages. I've just started to silence my phone so I don't worry about it, because I'll be looking at my phone every 30 seconds to see what's going on and I can't get anything done. And then I jump back, guys, and I want to talk about the market. Is everybody's running crazy about what's going on in the market, but realistically, all we can do is take what's in front of us and sell it. If that person fits that criteria, that home buyer or that home seller or that realtor, if it works, great. If it doesn't, you have to move on. But there's so many people pricing in these cuts by the Fed later in the year. They're now saying, we initially started saying 6 starting in March. Now the March price cut is completely gone. It's like down to 20%. And now they've started to unprice the May cut. It's now was like 80 or 90%. It's now down to 70, 68, 70%. Depending on what the numbers turn out in March, I don't know if we have any rate cuts anytime soon. We are going to continue to stay at this level until we get the fear out of the system and we figure out how we're going to pay our bills. And I'm going to end on that. How are we going to pay our bills? How does the federal government pay their bills? Through the treasury auctions, 1 month, 1 year, 2 year, 5 year, 10 year, 30 year. Guess what? We have trillions of dollars of debt. It's at the highest level. How do you attract people to those auctions so we continue to pay the bills, keep the lights on? Have the interest rates continue to go up. If the rates don't go up, how are people going to, excuse me, why would people bid on those auctions if they can't get that margin, or excuse me, that interest rate above 5%, above 6%. I don't know where that's going to go, but there's a telltale sign somewhere in there that we have to find a happy medium to make everything work. Because ultimately, if we stay in these sixes and sevens, there's no way our economy is going to continue to survive. You cannot have credit card rates in the 20s and not expect bankruptcies and defaults to go through the roof because we're spending on credit cards. We're using buy now, pay later, buy now, pay later. It doesn't work. So the system is broken. It needs to be fixed, but it has to start with interest rates. I'm not advocating for higher or lower. We have to find a sweet spot that works for the economy. Seems to be working right now, but I have a feeling those numbers are a little inflated. So, guys, true talk for today. Hope you guys have a good one. Talk to you guys later.